Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to another edition of What is Driving the Markets, where we discuss key events and address key questions on investors' mind. In today's episode, we discuss the factors that drove Indian equities back into correction zone and what it means for investors. Since the start of 2025, Indian equities have come under renewed pressure. The Nifty index is down 2.4% year-to-date 2025, while the broader markets have witnessed intense selling, declining 8% and 9.8% respectively. From their respective peaks though, the large cap, mid cap and small cap indices are down 12%, 14% and 14.2%. The 10-year Indian government bond yield is up 8 basis points so far this year to 7.85%, while the INR has depreciated 1.1% against the USD to touch 86.6, a new all-time high. Now, what has driven the recent capitulation in domestic equities? Well, we see the following four factors that have weighed on domestic equities in the recent past. First is weak global sentiments. Global equities have been under pressure as markets pushed back on US Fed rate cut expectations, policy easing being priced out for the entire first half of 2025, given that strong US jobs data, falling unemployment rates have driven bond yields higher and the USD closer to its 2023 highs. Additionally, the uncertainty around the inflationary impacts of Trump's proposed policy and its impact on emerging markets has continued to weigh on EM assets. Second factor is the increased uncertainty on the timing of RBI rate cuts. Elevated inflation, narrowing interest rate differential with the US, depleted forex reserves, rising Brent crude oil prices, and a sharp surge in banking system liquidity deficits has raised uncertainty on the timing and quantum of policy easing by the RBI. This has driven bond yields higher since the start of the year, weighing on domestic equities. Third factor is the muted earnings expectations for the third quarter of fiscal year 2025, which is expected to grow at 3 to 4% for the Nifty index year on year, making it the third consecutive quarter of muted earnings growth. So far, earnings reported by major banks, retailers, FMCG and IT companies have broadly missed consensus estimates. This has raised questions over the full year earnings delivery of nearly 7 to 8% for fiscal year 2025, which is what the market expects currently. The fourth factor has been foreign investor outflows and the INR weakness. After stabilizing in the month of December last year, foreign investors have turned net sellers of USD 3.3 billion from domestic equities. This can be attributed in part to the sharp depreciation of INR against the USD, which has declined nearly 3% from the month of September. This is in stark contrast to what we've seen in the entire of 2023 and 2024. Now, what does this mean for investors? Well, the immediate short-term view remains a rather cautious one, given several known risks. We expect markets to remain volatile over the coming weeks as weak global sentiments, muted domestic earnings, and potential Trump's policy announcement take the center stage. Nevertheless, we find that risk-reward has improved on the margin for Indian equities post the recent sell-off. The 12-month forward price to earnings for Nifty index has eased to 19.2x versus the September 24 high of 21x and the 10-year average of 18.2x. The fiscal 2026 EPS growth forecast for the Nifty index remains at a steady 4% despite downward revisions over the past 3 months. We believe investors should adopt a buy on dip strategy to average into Indian equities and build for the long term. In our view, the medium-term structural story for India continues to remain strong given ahead of peers' economic growth and strong earnings growth outlook. We prefer a diversified asset allocation with an overweight on equities in our foundation allocations, funded by an underweight on cash. Bonds remain a core holding, and gold continues to be a core holding and a solid portfolio hedge against uncertainty and a global growth slowdown. Within equities, we maintain a preference for large cap equities, given our view that it offers a higher margin of safety in terms of earnings and valuations, and their strong balance sheets to withstand tighter financial conditions or a growth slowdown. Within sector, we maintain a preference for domestic cyclicals, given our view of improving domestic growth through an overweight on financials and industrials. We balance this with a defensive overlay via overweight on information technology. At this point, I'll take a pause and thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.